are there any true canaries in the coal mine, so to speak, that we need to be leery of, as we think about putting that capital to work going forward?
Yeah, I mean, I think you're seeing some of them. Um, the high yield market is seeing very little in the way of issuance. CLO spreads are starting to widen, credit spreads are starting to widen. You've had this bout of nervousness and volatility in interest rates, and really for some time. And it's really shifting over to risk markets. And I don't want to be too hyperbolic, but what you saw last week in the performance of rates, equity, and currency was very much emblematic of capital leaving a market entirely. It felt like capital was being pulled out of the U.S. I don't know if that was happening. I suspect it will. So I suspect we're at the beginning of the process of finding a new equilibrium. And I think of advisors and sitting across the table from a client, and oftentimes this is not going to be the conversation they have, but I think it rhymes a little bit with a client's level of confidence in the economy. We're looking at survey data from places like the University of Michigan, right down the street from you guys, as well as the ISM, and both business and consumer sentiment have been, uh, to say they're in the toilet is generous. And I think that right now those sets of sentiment indicators are very much aligned around the same issues. And I suspect consumers will start to feel better after the bottoming in risk has occurred. But if they miss that little bottom, that's okay. And so I think a lot of advisors should be talking to their clients about their views of the economy, because right now it's actually really relevant, which it might not be in other cycles because there are other factors.